$35 doesn't sound like enough to change anything. It's lunch and a coffee. It's forgettable. But put it in the right place every single week, and it could start earning more than you do. Not because $35 is a lot of money, but because time turns small money into something your salary can't compete with. In this video, I'll show you why just saving your paycheck isn't enough, why investing weekly makes compounding work harder for you, and walk you through 5 Vanguard funds that cover everything from European markets, globally developed economies, to international dividend growers. And at the end, I'll show you Josh's complete Vanguard Index Funds portfolio with a full 10, 20, and 30-year projections, starting from just $35 a week, and how that portfolio could reach $820,000, paying over $8,000 every month in passive dividend income. Let's start with a moment you've probably felt before. You get a raise. Maybe it's a good one. 3, 4, maybe even 5%. And for about 2 weeks you feel it. The account looks a little better. You breathe a little easier. You start thinking about what you might actually do with the extra money. And then the bills come in, and somehow the math still doesn't add up the way you expected. That feeling isn't in your head. The numbers actually back it up. According to the Bureau of Labor Statistics, nominal wages grew 4.3% over the 12 months ending January 2026. On paper, that sounds like a real win. But here's where the illusion shatters. Over that same period, overall inflation ran at 2.4%. Food prices climbed 3.1%. Eating out got even more expensive, up 4.1%. Hospital and medical services jumped 6.7%, their steepest climb in over a decade. Coffee prices rose nearly 12%. So your paycheck went up, but so did almost everything you spend it on, and not by a little. By enough that after you account for all of it, the BLS Employment Cost Index shows that real wage growth, the actual gain in purchasing power, came in at just 0.7% for the year. That's it. Less than $1 gained in real terms for every $100 earned. Your raise didn't disappear. It just got redistributed before you ever had a chance to use it. And this isn't a one-year fluke. This has been the pattern for years. Wages go up, costs go up faster. The baseline resets, and you're back to running the same race on the same treadmill. Working harder inside that system will never be enough to truly get ahead, because the system adjusts around you every time you make progress. The only way to actually break out of that cycle is to build something that exists outside of it. Something that doesn't rely on a boss approving your raise. Something that doesn't clock out, doesn't call in sick, and keeps growing whether the price of eggs goes up or not. Here's a way to think about $35 a week that completely changes how it feels. Every time you invest, you're not just saving money, you're hiring an employee, a tiny invisible one that works around the clock, never takes a day off, never asks for a raise, and every single paycheck it earns, it immediately turns around and hires more workers just like itself. That's literally what compounding is. Your money earns returns. Those returns buy more shares. Those shares earn more dividends. Those dividends buy even more shares. The workforce keeps growing in the background, whether you're watching or not. Let's put real numbers to it with a simple example. Say you put just $20 a week into a basic index fund averaging around 10% annually. At the end of year 1, you would have invested $1,040. With market growth, the balance grows to around $1,092. That extra $52 looks almost laughable, but those are the first workers on the payroll, and they're already clocked in, already working, already producing. By year 3, total contributions reached $3,120, but the balance has grown to roughly $3,575. That extra $455 didn't come from your wallet. It came from the workers hired in year 1 hiring more workers of their own. By year 5, your contribution would be $5,200, but the portfolio sits closer to $6,700. Over $1,500 built entirely by the invisible workforce. And here's what matters most. That gap between what went in and what the portfolio is worth keeps widening every single year automatically. The workforce gets bigger, produces more, and hires faster the longer you leave it alone. Most people look at $20 a week and think it's too small to matter. But small doesn't mean weak. It means early. And early is the only ingredient compounding actually needs. Here's the part nobody talks about enough. Most people don't fail at long-term investing because they picked the wrong fund. They fail because they quit. And they quit for a reason that has nothing to do with the market. They quit because the early results feel too small to take seriously. You put in $35. Your balance moves a little. Your brain, which is wired to expect quick feedback and visible progress, looks at that tiny movement and says, "This isn't working. Maybe I should wait for a better time. Maybe I should do something else with this money." We're also wired to react emotionally to short-term noise. A bad week in the market feels like a warning. A recession headline feels like a signal to pause. A sudden drop feels alarming in a way that makes doing nothing feel irresponsible, even when doing nothing is exactly the right move. That reaction comes from thinking about markets in a straight line. We expect progress to look neat and predictable, but compounding doesn't work in straight lines. It works in curves. Slow at first, almost invisible, and then suddenly steep in ways that reward everyone who stayed. Markets rise, fall, shake around on the way up, and none of that disrupts the long-term outcome for the investor who simply stays consistent. The only question that matters early on is, did I invest this week? Not how much I made, not what the market did, just did the money go in? That's the whole game for the first decade. The returns take care of themselves if you do. Which brings us to what to actually invest in. So, what do you actually buy? Before I get into the specific funds, here's what I filtered for, because once you see the criteria, the picks make sense on their own. First, international diversification. Most people only own US funds. That's not a bad start, but it means your entire portfolio lives and dies with one economy. The funds I picked are spread across Europe, Asia Pacific, and developed markets globally. Different economies, different currencies, different cycles. When one region stalls, another is usually picking up. The second is dividend growth history. A fund that pays a dividend today is fine. A fund whose dividend has been growing consistently for a decade is far more powerful. Growing dividends means your income stream compounds on its own, even if you never add another dollar. The payouts rise, buy more shares, which generate higher payouts. That loop, left alone long enough, becomes the main engine of the whole portfolio. Third is low expense ratios. This one's boring, but it's brutal if you ignore it. A 0.5% fee sounds like nothing. Over the long run, it can eat tens of thousands of dollars out of your portfolio. Vanguard keeps costs about as low as they get, which means more of every dollar stays invested instead of leaking out to fund managers. And fourth, broad exposure across sectors and geographies. Markets rotate constantly. Large caps lead for a while, then international takes over, then a specific sector runs. You're not going to predict that. Nobody does consistently. So instead, you just own enough of the right stuff that no matter what's leading, you're in it. When you put those criteria together, 5 Vanguard funds stand out. Next, I'll show you what each one brings to the portfolio, and at the end, I'll show you how that portfolio could turn $35 a week into over $820,000, paying over $8,000 a month in dividend income. But first, let's look at the 5 funds that check all the boxes. The first fund is the Vanguard European Stock Index Fund Admiral Shares with the ticker symbol VEUSX. Think of this one as the European anchor. It holds large and mid-cap companies across developed Europe, Germany, the UK, France, Switzerland, the Netherlands. These are mature, established, globally competitive businesses that have been paying dividends for a long time. Right now, it yields 2.64%. Dividend growth over the last 5 years has been 13.44% annually, and share price appreciation runs about 6.87% a year. This fund's role is simple: geographic stability and a solid base yield from markets that don't always move in sync with the US. Next up is VTCAX, Vanguard Communication Services Index Fund. This is the growth engine. It focuses on the communication and technology sector, companies like Alphabet, Meta, Netflix, and the major telecom players. These are businesses sitting at the center of how the modern world communicates, consumes content, and accesses information. The yield is lower at 0.97%, but the dividend growth rate is the fastest in the portfolio, 15.86% annually. Share price appreciation is also solid at 8.31%. This fund's job isn't to pay you a lot right now, it's to pull the total value of the portfolio up over time. From there, we go wide with VTMGX, Vanguard Developed Markets Index Fund. This is the global backbone. Thousands of companies across Japan, Australia, Canada, Hong Kong, Europe. Basically every major developed market outside the US. It gives the portfolio the widest international footprint. It also happens to carry the highest current yield at 2.88%, with dividend growth matching VTCAX at 15.86% and price appreciation at 7.37%. So you're getting the broadest diversification in the lineup and one of the strongest income streams. That combination is hard to beat. Then there's VIAAX, Vanguard International Dividend Appreciation Index Fund. This one's the dividend compounder, and it works differently from a typical high-yield fund. Instead of just chasing whoever's paying the most right now, VIAAX filters for international companies that have been raising their dividends consistently, year after year. That screen naturally filters out the companies paying big dividends because they're in trouble and keeps the one doing it because they can actually afford to. It yields 2%, grows dividends at 12.95% annually, and delivers 6.85% in price appreciation. Its job is to strengthen the compounding loop, making sure the dividend income the portfolio generates keeps rising reliably over time. And rounding out the 5 is VIHAX, Vanguard International High Dividend Yield Fund. This is the income lifter. Where VIAAX focuses on dividend growth, VIHAX focuses on dividend size. It targets international companies paying above-average yields right now. It carries the highest yield in the lineup at 3.31%, with 11.06% dividend growth and 6.93% appreciation. This is the fund that makes sure the portfolio is putting real money in your pocket from the start, not just 10 or 20 years from now. Now that we have all the 5 funds for the portfolio, the next step is to calculate the portfolio's combined dividend yield. Since we're splitting our money equally across all 5 funds, we just take a simple average. You add up each fund's yield, 2.64% from VEUSX, 0.97% from VTCAX, 2.88% from VTMGX, 2% from VIAAX, and 3.31% from VIHAX, which gives you a total of 11.8%. Divide that by 5, and you get a portfolio dividend yield of 2.36%. That's the blended yield your money is earning across the entire portfolio from day one. You do the exact same thing for the other 2 metrics. Average out the dividend growth rates, and you get 13.83% per year. Average out the share price appreciation, and you get 7.27% per year. So now you have 3 numbers that define this portfolio: what it yields, how fast that yield is growing, and how fast the underlying value is climbing. Those 3 working together is what drives everything in the projection. So let's take those numbers and see what they actually mean in real life. Let's say Josh invests $5 a day, which works out to $35 a week, split equally across these 5 Vanguard funds. That's $1 a day going into each fund, an amount so small most people genuinely spend it without thinking. But for Josh, that small daily habit becomes the foundation of something that eventually outpaces his salary entirely. At the end of year 1, Josh would have contributed $1,820. That's not going to look impressive on a screen, but it lays the groundwork for everything that comes after. By year 10, things start to look different. The portfolio is projected to grow to around $30,000, and that year alone, Josh would be receiving roughly $1,100 in dividend income. By year 20, the portfolio would reach around $140,000. Annual dividend income would hit $9,000, about $750 every month. At that point, Josh's portfolio would be generating something close to a part-time income on its own, from nothing more than a $35 weekly habit. And then there's year 30. The portfolio would hit $820,000. Annual dividend income would reach $100,000, roughly $8,000 every single month. That would be more than many full-time salaries, coming in as passive income from a portfolio Josh built with $5 a day or $35 a week. Across 30 years, Josh's total out-of-pocket contributions would come to $54,600, but the portfolio would be sitting at $820,000. That gap, over $765,000, wouldn't be money Josh ever earned or deposited. That's compounding doing what it does when you give it enough time. Want to know how to turn the same $25 a week into a $1.6 million portfolio that pays over $6,000 in dividends every month? Click the video on screen to find out how.